PayPal shareholders are having a nightmare day today. The stock is down 20% just today on the back of some earnings that came out earlier during the day. And we'll go over those earnings to see what exactly is happening for the stock price to react this much. The reason I want to cover PayPal today is because I made a video on PayPal just over a month ago. I know that it's a business that's interesting to many retail investors that have invested in PayPal over the last few years since the 2021 drop. And so as a continuation for that series, after a stock price move like today, we'll make an update on that video and see what's up with PayPal. This video is not going to be made to bash on PayPal investors, but when something like this happens, it's important to look at the situation objectively and to see what key lessons we can get from that so that we don't make the same mistake again. If you have been invested in PayPal and you lost a lot of money today, it must be very painful, but it's so important for you to write down on a piece of paper the mistakes that you made so that you can take those into the future and never make the same mistake again. For those of you who are new to the channel, you are watching Rated A. Rated A is a curated database of investable companies, and the entire point is to separate the very high quality cream of the crop companies from the trash companies that you want to avoid at all costs. Once we know which companies are the ones we want to own and which companies are the ones we want to avoid, then we monitor the price, wait for it to get to our buy range if it's one of those that we want to buy, and then when that happens, we pull the trigger. Our philosophy is to buy high quality companies at a reasonable price and to hold for the long term. Let the companies do the hard work of compounding our money. No need for frequent trades, no need to stay in front of your computer monitoring your portfolio day in and day out. Go have a life, go enjoy your life. Just make sure that you make the right decision when you buy a company. Do the work beforehand. So far, it's been working quite well for us. We beat the market by a wide margin in 2025. So far in 2026, we're only in February, but we're doubling the market. The expectation is that this is a strategy that works and we will beat the market over the long term. Now, with that being said, let's get straight into the main subject of today. So what the heck happened to PayPal today? Like I said, they released the earnings report earlier this morning, and a little foreshadowing here, you can see that the message in the front row is by the interim CEO, Jamie Miller, and we'll get to what happened to the actual CEO in just a second. So for the full year, revenues increased 4%. That's actually not too bad for PayPal. If you look at our previous video, that's exactly what we predicted for the next 5 years. Transaction margin also increased, this time by 6%, and that's exactly what we want to see if we're a PayPal shareholder. PayPal is becoming more profitable per transaction. Operating income increased 14%, blah, blah, blah. So everything is looking good on that end. Let's look at the weighted shares outstanding because this is a major part of the bull thesis for PayPal, that PayPal has the means to purchase a lot of shares, and so that would artificially increase the free cash flow per share, making the shares more valuable. So we can see that the average shares went down from 1,000 to 959. This is amazing. You can even see that for the quarter, it's been down to 931. So 959 is the average over the last 4 quarters, and that's what's used for the earnings per share calculation for the full year. But PayPal is clearly really putting a dent in the share count. That's great. And if we have a quick look at the balance sheet, we can see that the cash and cash equivalents went up, the debt went down, and clearly PayPal has still a lot of firepower if it wanted to take on more debt to do more share buybacks. Now, whether that's a good idea or not, at this point, I don't think so, and I'll explain why in just a second. Speaking of free cash flow per share, let's look at the free cash flow. And we can see that it went down, the cash flow from operations, from 7.4 last year to 6.4 billion. So quite a drop. Now, on paper, this looks pretty ugly, but what I would like to highlight is that most of this difference can be accounted for when you look at this line here, which is PayPal's buy now, pay later segment. Essentially, PayPal made a lot more loans this year compared to last year, and they also received a lot more money back compared to last year, but they're still waiting for some of that cash to hit their account. And so the change in working capital is an explanation for why there's $1 billion of difference between this year's cash from operating activities and last year's. The stock-based comp went down by 200 million. That's pretty good. And the last thing I want to highlight is that the capital expenditures did go up as well. So overall, if you look strictly by the numbers, the free cash flow is down this year compared to last year. But all that aside, the key thing that freaked the socks out of this market is the guidance for 2026, because PayPal is guiding for mid-single digit decline in earnings per share. So that's it. Management is saying next year in 2026, the business will shrink. Now, this is a big problem because remember, a key part of our bull thesis for PayPal was that they would be able to maintain growth to 4% per year. Management hasn't made a prediction for what revenue will look like next year, but the earnings will go down, which means that margins will go down, at least over the short term, and this is not a good sign for PayPal. As if that wasn't enough, PayPal has officially sacked their CEO that's been in place, I think, for the last 2 years, replaced him with another CEO, Enrique Lores. Now, first of all, investors are going to be thinking, well, this means that the previous strategy wasn't working, which means we have to start all over from the beginning, look at the business holistically again, and make a new strategy, which is typically what happens when a new CEO comes in. But who is Enrique Lores? Well, he spent most of his career at HP. He's been the CEO of HP since 2019. And since 2019, the stock for HP is in decline. It's down 2.6%, while the S&P 500 has more than doubled. So that's not exactly a good sign, but it also helps to see what kind of company HP is. Because HP is what I would consider a legacy type of company. There's no growth baked into the assumptions for HP. It's actually one of the companies we cover on Rated A on the database, and its quality rating is at F. It's the worst rating you could have. And that's because HP sells a commodity product. It sells printers and desktops. It has absolutely no moat. The moat score is 0. And maybe you could say that the new CEO, Enrique Lores, has done a good job at HP by keeping the revenues stagnant for the last 7 years. He's also executed a ton of share buybacks for the company. He has increased the dividend by quite a margin from 64 cents per share today to 1.16 cents per share. So this is a guy that's going to take a company that's very stagnant and that has no growth and return lots of capital to shareholders. That's the type of CEO that he is. And so when you see PayPal appointing a guy like Enrique Lores to the head of the company, it can show you a sign of what type of strategy PayPal is wanting to execute over the next few years. If they wanted to revolutionize the payment sector and had grandiose ideas, they would have gotten the next Jensen Huang, not this guy. So there are 2 main lessons that I think investors should take away from this situation, whether or not you are an investor in PayPal and have been hurt by this drop. After all, it's always better to learn from the mistakes of others than to reproduce them for ourselves. Number 1, focus on the quality of the company over anything else regarding the valuation, etc. When I made my last video on PayPal, I highlighted the fact that PayPal is a low quality company. It's rated as a D, which means that it has less of a moat than other companies. It's growing less fast than other companies, and maybe the risk is more elevated than other companies that are available for investment on the public markets. And I made sure to highlight that PayPal's biggest deficiency out of the 3 is the moat. I showed this graphic here to illustrate just how crowded the fintech sector is. Yes, PayPal has an acquiring business where it competes with Fiserv, Square, Adyen, and a whole bunch of other smaller competitors that don't fit in the chart. But PayPal is also a gateway, and part of their business directly competes with Stripe, Shopify, Klarna, Braintree, and others. PayPal also competes with many other companies in buy now, pay later. It also competes with other companies in peer-to-peer payments. PayPal has Venmo, but there's other alternatives to that. So PayPal does not own any market, which means that PayPal has to compete on price. And as a company, for the long term, that's never a good position to be in. Because from the chatter online and from the comments on my video, it's very clear to see that the number one argument for the bull thesis of PayPal is the buybacks, that PayPal is generating a good amount of free cash flow. And yes, that is true. That cash flow is worth something. But then proponents of PayPal would say that the company can use those cash flows and invest in buying back its own shares very rapidly. And that's what the company is doing. And if the company has a moat and if it can grow its cash flows over time and buy back shares and reduce the share count, then that's like putting fuel on the fire and you get a firework at the end. But that's only if the company can increase its free cash flow over time. Because if the earnings or the free cash flow decreases faster than the share count, then your earnings per share are decreasing anyways, whether or not you are buying shares back. And the capital that PayPal is using to buy back shares instead of investing in improving the business and the moat, that's capital that shareholders will never see again. For example, when PayPal was spending its free cash flow on buying back its own share at $80 per share just a few months ago, well, that would be considered destruction of capital at today's price levels. So yes, it's good to see the free cash flow going up. It's good to see that the company is returning cash to shareholders via a dividend that it just started and by buying back its own shares. But when you make your analysis and you're investing for the long term, it's always better to focus on the quality of the business. Otherwise, you just get a melting ice cube situation. And that's the typical value trap. It's happened to me before when I made an investment in Intel, and it's happened once again to many other investors who were buying PayPal just a few months ago. And remember, just because the stock is down 20% today and it's now at an all-time low, doesn't mean that it's a good price today, because the stock price can always go lower. If you buy it today and the stock goes to $20 per share, which could happen, then you have lost half of your money again, minus 50%. So definitely don't make the mistake of using price as a reference point, as an anchor point, because nobody can guarantee that the stock price will recover and go back to the 80s one day. The second key lesson here is to always use conservative assumptions when you are making your calculations for the valuation. Because at the end of the day, the valuation is just an exercise. You can make any reality you want come true by just tweaking some numbers on a spreadsheet. That spreadsheet or that calculator is only there to let you know approximately what needs to happen for you to get your desired return rate over the next few years. What type of hurdles does the business need to jump over for you to get the return you want? Is it a 5-kilometer hurdle where the company is expected to deliver outstanding results just for you to get a 15% return per year? Or is it a 1-foot hurdle where the company just needs to grow by 1% in order for you to get the return you desire? Today's valuation exercise that I'm going to do with PayPal is a bit different to the ones I usually do. I'm going to input the assumptions that the market is currently pricing in for the stock to be priced at $42 per share, which at the time of recording, that's where the stock is at. We're both going to go through those assumptions together, and I'll let you decide for yourself if you think that these are reasonable assumptions or the market is getting it completely wrong and PayPal stock is gonna double or triple by the end of the year. Okay, so we've got the current revenue that they just reported. I'm putting a 3% growth rate. Remember that PayPal just announced 4% growth for 2025, but they're expecting the earnings to go down. So either the revenue is gonna slow or the margin is going to decline. It's gonna be one or the other. So we're going to keep the growth rate at 3%. and the margin at 12% because PayPal has been doing 15 or 17%. And so in order to reflect the decrease in earnings per share, I'm going to make the majority of my adjustment on the margin. I'm going to assume a ton of share buybacks. Right now, PayPal is at 930, so I'm assuming 800 by the end of the next 5 years. A terminal multiple of 12, which you might argue is not enough, but I will tell you that for a company that's growing its revenues at 3% and has no moat, that's the multiple that I would expect and that the market expects. If the dividend grows 5% per year and you reinvest the entirety of it, then you can expect a total shareholder return of 12-13%. That sounds like a little bit better than the market, but if you're picking individual stocks like PayPal to invest in, then I would say that's the market price because you do expect a little premium if you're going to be investing in companies as opposed to just parking your money in an index. You want that little premium for the extra risk that you're taking on. So you tell me, are these assumptions too low? Do you think that PayPal can grow revenues at 5% and increase its margin over the next 5 years? Do you think it's going to be a quick turnaround after 2026? I don't know. I don't have all the answers, but this is kind of what the market is expecting. And this is why the stock price is just cratering today. So hopefully this gives you some insight as to what is happening and why quality is so important to focus on when you make long-term investments. Thanks for watching today's video, and I'll see you in the next one.